Hey guys, what's going on? We're back with another individual stock analysis video. This one was very highly requested by some of you out there, leaving comments and sending me messages and that sort of thing. So I thought that I would go and have a look at it. We're talking about Nvidia today, and I think you will be surprised at how amazing their numbers have been over the past 10 years, not just in recent times where their stock price has blown up on the stock market, but their performance over the past 10 years has been absolutely amazing. So I'm excited to talk about that with you guys today. If you're new around here, make sure you hit subscribe so you don't miss out on these. We do them every single Tuesday, and then we also have a video coming out on Thursdays, which is a bit of a random video, and then on Saturdays we bring out the new episode of YouTube Stock Portfolio. So if that's something that you're interested in getting updates about, make sure you become a subscriber and hit that notification bell so you get notified when I'm posting. As per usual in these analysis videos, we're going to start off with a brief overview of what the company is, how they make their money, that sort of thing. Then we're going to have a look at the economic moat in terms of a qualitative moat, and then a quantitative moat backed up in those four key numbers, which are the earnings per share, the revenues, equity and free cash flow. Then we're going to have a look at how effective management has been over the past 10 years in terms of investing their capital and also managing their debt. Then we're going to have a look at the value matrix. What return can we expect to get over the next 10 years? And lastly, as per usual, we're going to do our intrinsic valuation and come up with a buy, sell, or hold decision. Just before we get started, I need to say that I am not a financial advisor, and I'm certainly not your financial advisor, so everything here is just for educational and entertainment purposes only. I don't know your personal circumstances, so please do your own research, and if you need advice, please consult a financial advisor. So let's start off with that company overview. Nvidia is essentially just an American technology corporation that's out of California, and it was actually founded all the way back 25 years ago in 1993. 84% of Nvidia's revenues come from its graphics processing units, also known as GPUs, for gaming and professional markets, and then the remaining 16% comes from their mobile processing Tegra products. Nvidia currently has a whopping $160 billion market capitalization, huge corporation. It has a PE ratio of 39 and a dividend yield it pays out at 0.22%. Alright, so let's talk about the economic moat in a qualitative sense. Is there some kind of quality or characteristic about Nvidia that's going to allow it to remain a primary competitor in the GPU marketplace over the next 10 years? And I think it has really two main qualitative economic moats. The first one is an industry standard moat, which means that Nvidia is basically one of, if not the biggest industry standard in the GPU marketplace, and in Nvidia's case, they are the industry leader by a mile. They have over 70% market share in the GPU space, and a significant proportion of all gamers use Nvidia products in their PCs. Then the other kind of moat that I think they have is what's called a switching moat, and they kind of have this, but not really. Basically, what a switching moat is, it's a kind of economic moat that means that once your customers are customers of your company, they're unlikely to leave because it's either difficult to leave or it's inconvenient or something like that. And I think Nvidia has this because if you don't know how computers work, when you're building a PC and you're putting the parts together and that sort of thing, there's certain components that work with other certain components. So if you build a computer and you put an Nvidia GPU in your computer, you would have picked other parts such as the motherboard and the CPU that are compatible with that graphics processing unit. So if you were then maybe 5 years later going to upgrade that GPU, you're unlikely to completely change all of the parts just to switch to a competitor such as AMD. You're more than likely going to keep your other parts, swap out the GPU, and just get another Nvidia GPU and put that back into the computer. So in that sense, I think that it does have somewhat of a switching moat. But of course, we can't just assume that these qualitative moats are enough to fend off its competition for the next 10 years. We need to make sure that it also has a quantitative economic moat, meaning that this kind of moat, the industry standard and the switching moat, those moats are backed up in their numbers, and their numbers are amazing. So it proves that they've been able to fend off competition in the past, meaning that they're likely going to be able to continue that performance in the future. And the four areas that we always look at for assessing this is the sales or the revenue, the earnings per share, equity, and free cash flow. Alright, so as you can see, these numbers are absolutely amazing. We've got everything green except for a couple of negative numbers there, and one yellow, which is just under 10%, which means it was very close to being a green. And if you look at that graph, that is just an amazing thing to see. All of these numbers are easily above 10% over the long term. Sales growth long term has been over 12%, equity growth long term has been 13.5%, and EPS growth over the last 7 years has been over 40%, which is incredible. And as you can see from the graph and from the table as well, these numbers have been getting stronger and stronger each and every year, which is a great sign because it means that their moat has been very, very strong and they're able to fend off competition and become even more competitive over that 10-year period. What this also means is that we can use these long-term numbers in the 12 to 15% range and be confident that they're going to be able to get that kind of growth over the next 10 years, because not only have they been doing that in the past, their numbers have been improving each and every year, and in the last few years, 62% EPS growth compounded over a 3-year period and an 88% EPS growth this year. So they've been growing at a really, really high rate. So from that table, I think we can easily conclude that Nvidia does have a very strong economic moat in a qualitative and in a quantitative sense. And by the way, if you want access to the spreadsheet that I just showed you, it does all the formulas for you and allows you to calculate growth rates over time. There's a link to it in the description below. It's completely free, and there's also a video on my channel explaining how to use it if you want to watch that and get access to all the features within the spreadsheet. Okay, so that brings us to management effectiveness. How effective has management been for Nvidia in 1, investing their capital within the business, and 2, at managing their debt? But before we get into those 2 areas, I just want to mention one other thing that makes Nvidia's management really, really strong. One of the things that I really like to see in newish businesses that have been around for 20 or 30 years, or maybe even a little bit less, is that the founders are still in power within the business. They're still the CEO or the chairman or the president of the board or something like that. And that is actually the case for Nvidia, even though it was founded 25 years ago. One of the co-founders, Jensen Huang, is still the CEO and president of Nvidia, which is a really, really good sign to see within a business, because straight away it means that the company's or the management's values are directly aligned with the shareholder values. The people who created the company, who had the vision for the company and got it from zero to where it is all the way now at a $160 billion business, those people are still in power and still making decisions for shareholders. That is a really, really good thing that I like to see. Alright, so let's jump into the first area of management effectiveness, which is how effective has this management team been at investing within the business. From all the money that they've gotten from last year and the quarters before, all the money that they're bringing in, how are they managing that? How are they investing it? And what kind of return are they getting on their investments? And of course, as always, I like to look at the return on invested capital to assess this, because it tells us directly from the money that they're investing how much return are they getting on that money. And we like to see this number over 15%. And following those amazing growth numbers, they've done amazing return on invested capital as well. Over a 5-year period, they've done 17%, which is incredibly high. That's a really, really good long-term ROIC. And then in the last year, they've had a return on invested capital of 45%, which is insanely high. It's one of the highest I've seen. And it means that they're really, really effective at investing money within the business, and it's an amazing sign, and it shows that I personally would have confidence in giving my money to the management team and letting them invest it within the business and see what return they can get for me. So now that we've covered that, we want to have a look at the debt management. How effective have they been at managing their debt and keeping it low? And again, Nvidia has just blown me away with this. Their current ratio for their current assets and current liabilities is a current ratio of 8, which means that they've got 8 times as much cash and cash equivalents and short-term assets than they do short-term debt that's due in the next 12 months. So they can easily cover their short-term liabilities. That's a really great sign to see. And then if we look at the big debt picture and we compare their debt to the equity, they have a debt to equity ratio of 0.5, which is exactly what I like to see. I like to see companies that have twice as much equity within the business as they have debt, and that's exactly what Nvidia's got. So they have easily covered or ticked the box for me for management effectiveness on both fronts, on the capital management front and the debt management front. So that finally brings us to have a look at the value matrix and then do an intrinsic valuation. So let's jump over to my computer and have a look at those numbers. Alright, so having a look at the value matrix, we can see that there is a variety of different outcomes that could happen from this stock depending on how they perform. The lowest growth rate I've got for Nvidia in here is 3.37% per year, which is extremely low. I actually probably shouldn't have that in there because it's very unlikely that they will do that, but I like to have a worst case scenario in my table. And then I've got a range of different options for how much they're going to grow over the next few years. I've got that 3%, I've got that 7%, I've got a 13%, a 17%, and then a 20%. And then within the middle of that table, you can see what return you would get each and every year if you invested right now, and then if the company performed in that certain way. So for example, if the company manages to do 20% growth each and every year for 10 years, and they have a PE ratio of 33 in 10 years time, then you would get a return of 16.85%. So now let's do that intrinsic valuation, and we need to input a couple of things before we get started. We need the EPS, which has been $6 for the last 12 months. We need what time period we're looking over. Let's look over a 10-year period. We need the current stock price of $263 per share at the time of recording this, and then we need what margin of safety we want, and I always use 50%, and what return we want to make on the stock, which I've picked 15%. So if we then come over to the manual buy zone calculator and we assume a growth rate of 15% per year for 10 years, then that gives us a fair value of just under $200 per share, which is a bit of a discount to what the current stock price is. And of course, we need to give a 50% margin of safety from that fair value. So that would mean that our buy price would be $100, which is a long way away from the current stock price of $263 per share. Interestingly enough, if we only look over a 5-year horizon and we use the growth rate for their earnings per share that Nvidia has achieved over the past 5 years, which is 40%, then we actually come to a fair value of $530 per share, which means 50% discounted. The current buy price would be basically the current stock price. So that basically says that if you think that Nvidia can do 40% growth each and every year for the next 5 years, as they did over the previous 5 years, then it would be a current buy right now. Although I would be very, very cautious in using a growth rate as high as 40%. I really don't put anything in this calculator above 30%. If we're looking over a 10-year period, I don't put anything in there above 15% really. 15 to 20% would be the maximum I would, just because companies don't do that over a 10-year period, or it's really rare that companies do that over a 10-year period. But again, if you think, you might think differently. If you think that Nvidia can do 40% growth, then it could just as well be a buy at the current stock price. Thanks for watching, guys. I hope you enjoyed this one. Make sure to let me know your thoughts on Nvidia down in the comments section below. If you're new around here, make sure you become a subscriber. Hit that subscribe button, join the team. But for now, I hope you guys have a great day, and I'll see you in the next one.